Joining us on the show today, Shri Paravaikkarasu, Director Asia Oil at FGE, to shed some light perhaps on what's going on. Shri, thanks so much for joining us. When we saw that crash, of course, there was this entire explanation around the futures contract, so on and so forth. Explain to us what's happening now, what explains this kind of complete bump up in oil.
Thanks for having me, Aisha. Probably what we saw last week, the big revision or the downward revision in US prices, was a little exaggerated, I would say. So what was happening was the market started to realize that the OPEC plus production cuts were too little to deal with the demand collapse situation what we have in hands. So crude prices have been generally, pressured over the last 2 weeks, and the OPEC cuts did not help too much, or the announcements did not help offer too much of a price support. But then this problem was very specific to the US market, I should say. What was happening was we had like the recent EIA data release, which showed close to 6 million barrels per day of demand decline in US. And there was also a very strong stock build, close to 20 million barrels. And that was the time when the NYMEX contract was expiring. So it was a combination of a lot of things which led us to that negative drive. It was an exaggeration, and I think things are getting back to a little more stable mode.
Okay, so what do you feel is going to be the new normal, particularly post the cut that is still to come? In the meanwhile, there's some kind of commentary saying that Trump could possibly look at a block on imports to prop up the US market, as you were just pointing out as well, that the US seems to be the center of this right now. So what are some of the dynamics that could play out in order to perhaps get to a stable price range for oil?
Okay. So there are a few things which we need to look in here, Aisha. The first and foremost is the announcement which was made by the OPEC Plus group. I think if I remember the number very correctly, they called for a 9.7 million barrels per day cut. But as analysts, when we look at it and compare with the benchmark or the reference points, clearly it's going to be somewhere around 7 to 7 million barrels per day. So this is the first point to be taken into consideration. And the second thing is the lag. So this is going to be effective only in May, which means we are still handling close to like 26 million barrels per day of demand collapse on a daily basis. So there are going to be tremendous stock builds happening between now and say the next month. And the last part definitely is comparing the demand numbers with the production cuts, what will happen in May. Again, it's going to be too little. The production cuts are no way close to the demand collapse what we would see. So to me, a stable market will come only probably, the later half of the year. We will have to embrace a lot of volatility in the oil market in the next 2 months, despite the big announcements made by the OPEC Plus group.
Right. Okay, Sri, we'll leave it at that. Thanks much for joining in with your take on crude and where oil prices may be headed. Just very